Today, I'll be taking you through the Redefine Properties company update report post the interim results. Just on the executive summary, so Redefine released its interim results on the 8th of May. The market didn't like the results at all, given the fact that the share was down as low as about 6% on the day. And from the release of the results to date, the share is down about 5%. We update on intrinsic value from R5.40 to R4.67, and this is based on a weak macro and the current operating environment, with the weak macro putting pressure on top line growth, while the operating environment speaking more to cost growth, outpacing top line growth, and expecting margin compression. We forecast low top line growth based on weak fundamentals on SA assets. Redefine is SA biased, with only about 16% of its revenue for the interim period coming from offshore. We maintain our buy recommendation, and this is based on upside on our intrinsic value despite our conservative estimates. So we saw revenue up about 36%, with distributable income only up about 7.2%, which speaks a little bit to earnings quality. But really, again, we are seeing most of the growth seen in the top line being lost in the growth of the property expenses outpacing the top line. So what we're seeing here is load shedding costs continuing to spiral up, given that we are experiencing higher load shedding levels for longer, which makes the backup power a little bit less efficient, as well as makes powering the backup power more expensive as diesel costs continue to spike up. We are seeing the interest expenses increasing as well, as debt has to be refinanced in a higher interest rate environment, as well as property expenses such as rates and taxes increasing on a year-to-year basis. Portfolio occupancies have slightly decreased from 93.3% to 92.5%, and that's more attributable to the SA vacancies, particularly in the industrial segment, where we saw an increase in vacancies, and management was explaining that the increase in vacancies was due to a tenant vacating a large industrial asset, but they expect that space to be occupied by the end of the period. International vacancies have decreased from 3.5% to 2.9%, again showcasing much stronger fundamentals amidst a weak macro environment in the region. The LTV went up from 40.2% to 40.9%. It is still within management median target range, however, it is on the higher end of the range. But the tone that management gave was that they expect the LTV to be sub 40 by the end of the next reporting period, which would still be relatively high. Dividends per share was down about 14.2%, and just on guidance. So management has maintained their payout guidance for 80 to 90% payout ratio. And for the interim period, the payout ratio was about 85%. However, when it came to the distributable income per share, that was guided downwards, and the tone was that it's more attributable to increasing cost of debt as well as property expenses, which should put pressure on margins, and that is also the basis of our stance.
Thank you very much for joining us today.